The salary versus dividends debate is one of the most misunderstood decisions Canadian business owners face. And the conventional wisdom that dividends are always better because you avoid CPP contributions may cause some entrepreneurs to overlook important long term trade offs. Let me show you why. Hi, if you are new here, my name is Elizabeth, and I am the founder of Boss Budget Labs. I help Canadian business owners make smarter decisions with their money. And today, I am breaking down exactly how salary and dividends actually work so you can stop guessing and start optimizing. Here is what we are covering. First, how salary and dividends are actually taxed and why the math is not as simple as it looks. Second, the hidden trade-offs most accountants never explain. And third, a practical framework for deciding which approach makes sense for your situation. If you find this helpful, do not forget to like, comment, and subscribe for more real-world money advice. How salary and dividends actually work. When you pay yourself a salary, your corporation deducts that amount as a business expense, reducing corporate tax. You then pay personal income tax on that salary and contribute to CPP. Most people stop there and conclude dividends must be better because you skip the CPP contribution. But here is what most business owners miss entirely. Canada has something called the dividend gross up and tax credit system, and it changes everything about how you should think about this decision. When your corporation pays you a dividend, you do not just pay tax on the cash amount you received. The government grosses up the dividend by adding a percentage on top, which is meant to represent the corporate tax already paid on that income. You then receive a dividend tax credit to offset part of that gross markup. Here is where it gets important for small business owners specifically. There are two types of dividends in Canada: eligible and non-eligible. If your corporation benefits from the small business deduction, which most incorporated small business owners do, the dividends you pay yourself are typically non-eligible dividends. Those are grossed up at 15%. So if you pay yourself $10,000 in non-eligible dividends, you report $11,500 on your tax return, then receive a credit to partially offset that. Eligible dividends, which apply to income tax at the general corporate rate rather than the small business rate, carry a higher 38% gross up with a larger corresponding credit. Why does any of this matter? The system is designed to create what is called integration, meaning you should theoretically end up with roughly the same after-tax dollars whether you take salary or dividends. In a perfect world, the choice would not matter much, but we do not live in a perfect world. And this is exactly where the long-term differences become meaningful. Hidden trade-off. 1. CPP. This is the one everyone gets wrong. When you pay yourself a salary, you contribute to the Canadian pension plan. As a business owner, you pay both the employee and employer portions. That can feel like a significant amount going out the door. But here is what your accountant probably never calculated for you. Those contributions build a retirement benefit that lasts your entire life, indexed to inflation, guaranteed by the government. If you consistently contribute at or near the maximum level throughout your career, CPP can provide a meaningful inflation-protected income stream in retirement, one that keeps paying no matter how long you live. So if you take only dividends throughout your career and never contribute through employment income, you will not build CPP retirement benefits through those earnings. You may save money today, but you are also walking away from a future government benefit that compounds over decades. Now you might be thinking, I will just invest that CPP savings myself and come out ahead. It's a fair point, but let me ask you two honest questions. First, will you actually set that money aside every single year without fail? And second, are you confident you can match a guaranteed inflation indexed lifetime income stream that you literally cannot outlive? For many people, the honest answer to both is no. Hidden trade-off. 2. RSP room. This one sneaks up on people. Salary creates RSP contribution room. Dividends do not. Not reduced room, none at all. If you pay yourself a $100,000 salary, you generate $18,000 of new RSP room the following year. That is $18,000 of additional tax-deferred contribution room that can compound significantly over time. And if you take dividends instead, that room is never created. Over a career spent paying yourself entirely in dividends, the cumulative loss of RSP room can materially reduce the tax-deferred savings available to you at retirement, exactly when you need that flexibility most. Hidden trade-off. Number 3, financing and credibility. This one catches business owners off guard at the worst possible time. Dividends give you flexibility. You can pay them whenever you want, in whatever amount suits your business cycle, and salary requires payroll, source deductions, T4s, and regular payments. For business owners with a regular income, dividends can seem like the easier path, but that flexibility has a hidden cost. Without a regular salary, qualifying for mortgages, lines of credit, and business financing becomes harder. Lenders generally prefer predictable T4 income. Dividend income from your own corporation raises questions because you control the amount. I have seen business owners with substantial dividend income face more scrutiny from lenders than borrowers with straightforward T4 employment income, often at exactly the moment they need financing most. A 4-step framework. So what should you actually do? Here is how I work through this with my clients. Step 1, understand your cash flow reality. If your business income fluctuates significantly, dividends give you the flexibility to match your pay to your actual profits without committing to fixed payroll obligations. Step 2, calculate your CPP payback period. If you are younger and expect many more contributing years ahead, the long-term CPP benefit built through salary may become more valuable than it first appears. Run the actual numbers for your age and income level before writing CPP off. Step 3, map your RRSP strategy. If maximizing tax-deferred growth is part of your retirement plan, salary creates the room to do that. If you are already at your contribution limit or have no intention of using registered accounts, this factor weighs less heavily. Step 4, look at your complete financial picture. Your spouse's income, your retirement timeline, your exit plan for the businesses, your financing needs in the next 5 years all matter. The right answer depends on these factors working together, not just which option shows a lower tax bill this year. Salary versus dividends is not about finding one right answer. It is about understanding the trade-offs and building a strategy that fits your actual life. The business owners who get this right are not the ones chasing the lowest tax bill today. They are the ones building a plan that aligns with where they actually want to end up. Every year you default to the same pay structure without revisiting it is a year of planning you cannot get back. If you are ready to take control of your finances and start building real wealth, book a free call with my team using the link in the description below. And if you want to keep learning and connect with others on the same journey, join my free school community. The link for that is in the description too. Thank you for watching. See you next time.